If it is something like subprime mortgages, then remember what happened last time. It almost blew up the whole banking system. And look at how many private equity companies there are out there right now. It's not the great taking yet, but it may well be subprime mortgages volume 2, so we'll just have to see.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 9th through March 16th, 2026, while supplies last. First this week, 1 ounce gold buffalo are just $199 over spot per ounce. Next, 1 ounce silver maples are $8.99 over spot. 40% U.S. junk silver halves are $3.50 below spot per ounce. And 90% U.S. silver junk dimes and quarters are $1.50 below spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm always glad to have this good, long-loved returning guest, John Rubino, who was the founder of dollarcollapse.com and now has his own substack. We'll talk about that later. Joins us this Monday, March 16th, 2026 on Liberty and Finance. John, thank you for coming back on.
Hey, Dunnigan. Thanks for having me back.
You graciously relented and yielded up this time from your travels because I was urgently asking you multiple times if we could get you on. There was an article that you penned recently asking, is this the beginning of the great taking? And we want to get your weigh in on that because it is so critical. Part of liberty and finance is the freedom aspect, and the freedom that comes from having our own assets that we are the actual owners of. Private property rights are absolutely essential to freedom. Otherwise, we are become dependent slaves and waiting for handouts and therefore subject to the rules and the restrictions and the fear of being cut off and cut out. Can you talk to us about why you wrote this article recently? We'll put a link to it in the description of this video. Is this the beginning of the great taking?
Yeah, well, we have a shadow banking system in the U.S. and I guess globally right now where it started with private equity, and there are now more private equity companies in the U.S. than there are McDonald's restaurants. It just exploded, and it's like I said, shadowy. We don't know who is doing what, who has what paper is going bad or anything, except that some of it is starting to go bad. There's an offshoot of the shadow banking system called private credit. And that's where some rich guys get together, they pool their money, and they start acting like banks. They fund company startups or they participate in the roll-up of some category of small businesses or whatever. And yeah, they behave like banks. But nobody's really paying attention to them. That's the thing. And when they start to go bad, it makes you wonder if they're the subprime mortgages of this generation. And things are starting to go bad in the private credit market. There are some big ones, some big funds, and some big individual private credit companies that are starting to blow up. And they're responding to their troubles in different ways. Some of them, or one of them at least, pooled money from their existing investors and used it to pay off the people who wanted to cash out. Others are basically doing what they call closing the gate. In other words, they're just saying, no, you can't have your money back. So that resembles conceptually what people think of as the great taking, where something bad happens in the economy, and we find out our bank accounts, our brokerage accounts, our private equity investments aren't really ours. That's not our money. It's somebody else's money, and they're going to keep it. And I think we're not there yet where it's a whole societal issue, but we are in a situation that's kind of similar to 2007, 2008, when a category of the financial system starts to go bad. And then it becomes the first domino, which knocks down a lot of other dominoes. And you get something like the Great Recession. So we're on the edge of something like that. It could well be that private credit is this decade's subprime mortgage. And it could be something that leads to something much bigger than right now it looks like. So pay attention to it. If it is something like subprime mortgages, then remember what happened last time. It almost blew up the whole banking system. And look at how many private equity companies there are out there right now, and assume that not all of them are run by super geniuses. We didn't automatically create 16,000 new, 170 IQ money managers out there to run these companies. So they probably made a lot of mistakes. There's probably a lot of malinvestment, and some of it going bad could lead to a lot more of it going bad. So, it's not the great taking yet, but it may well be subprime mortgages volume 2, so we'll just have to see.
The concern that many of our viewers have that what most people believe to be their deposits in the banks, credit unions, whether it's checking, savings, certificates of deposits, the contents of safe deposit boxes, etc. Our viewers are concerned that those don't belong to you is well-founded concern based on laws that were passed after what you just described. The global financial crisis of 2007, 2008 came the Dodd-Frank Act of 2009, which went into effect in 2010. Can you explain why that puts legal teeth behind people's concerns?
Well, originally we bailed out banks when they got into trouble. And that was very politically unpopular, but it isn't nearly as unpopular as just taking money directly from people. And that's kind of where we are now. There's a concept called the bail-in, where based on some of the laws, like you said, that have been passed since the Great Recession, it's possible that if a bank gets into trouble, they just seize their depositors' assets and use that money to bail themselves out, or the government does it for them. So we find out that this isn't really our money, and if that were to happen, it could happen on a small scale, and it could still freak everybody out, because if that bank is that way, why not your bank, And then if we take our money out of one bank or a series of banks, then that can bust those banks, and you get a kind of a cascade failure of the whole banking system. We almost saw that a few years ago with the failure of Silicon Valley Bank. But the government immediately stepped in, used loan guarantees and other kinds of mechanisms to keep them all from failing. But if it happens on a bigger scale now, if multiple banks fail and start implementing bail-ins where they just keep their depositors' money, then who wants money in a bank, And I would argue that we're not that far from that point right now, and the whole private credit thing could be what starts the avalanche. We'll just have to see. Again, we can't know how this plays out for sure, but we've got a lot of potential catalysts out there. And because of that, we need to be paying attention to what happens in these sectors, especially in the shadow banking system. And we need to be ready to move our money, if we've got a bunch of it exposed, to a safer place. So there's an old saying, he who panics first panics best. And this is the kind of situation that panicking early might be the best move.
Well, for more than one reason. The old saying in the preparedness community is, I'd rather be 7 years early than 1 day late, because once the crowd understands that you got to get your funds out of there, it's too late. And you've just pointed out that the gates can be closed and are being closed in some examples where you simply will find that you have capital gating restrictions. Oh, sure, you can move $500 a day or $1,000 a week or whatever, but that's not going to let you get your job done that you need to do to move to safety. Your flight to safety has to happen in the calm times when it's not obvious to everyone that needs to happen. Any further connections for you between that idea of being an early mover versus and in this flight to safety?
Well, Diligen, you and I have been talking for years about the transition that most people should go through. In other words, we should move our capital out of financial assets like bank accounts and big cash balances elsewhere, and money market funds and government bond funds, things that depend on the value of the currency for their value. Because the currency is depreciating at an accelerating rate, and we don't have the rules at our backs anymore. We don't necessarily own our deposits in a lot of financial institutions. So we ought to be moving now, gradually. It doesn't have to be tomorrow where you shift everything over, but we ought to be using dollar-denominated assets in the U.S. to buy things that don't necessarily have counterparty risk, can't be created out of thin air by governments. And in other words, we should be gold bugs if we're not already. We should be buying gold and silver. We should be buying, to a lesser extent, the equities of companies that have real assets, oil companies, uranium companies, things like that. And we should just be gradually doing that, building up piles of gold and silver that are stored in a safe place, and that will come through a great taking scenario in really good shape. You know, they'll take the financial assets before they come after the real assets. So that gives you time in which to make plan B and plan C if any of this starts to happen.
When you say stored in a safe place, that I often am questioned by people who've been concerned for some time and perhaps accumulating a significant asset, a nest egg, moving their family's nest egg into real assets like gold and silver, in addition to some other things. But they ask, should we have it all in your own possession? Should it be in the vault? Should it be a hybrid solution of the two? You've done some thinking and some writing about this. What alternatives have you come up with, and what perspectives do you encourage people to reflect on when making that kind of a decision, where they store their treasure?
Well, you know, that's the subject for a whole show, maybe a whole book, because there are a lot of different strategies for storing physical gold and silver. And none of them are risk-free, but all of them have advantages. So you have to kind of think about your own self. First of all, like what are your needs? What's your risk tolerance, et cetera, and then start implementing kind of a diversified gold and silver storage program. First of all, you want some that you can get to. There are lots of ways to store gold and silver that allow you to access it. And, you know, the funny thing is, or the sad thing is, that you can't talk specifics on a show like this because that's giving important information to would-be thieves, right? You know, if I say, okay, well, here's the 5 most popular ways of storing gold and silver, then if you're a potential thief, and then now you know what to do when you break into somebody's house. You go through that 5 place checklist, and then I told you to put it in a place where it was going to be stolen. You know, so we can't talk specifics about any of this. And in any event, it's a person-specific decision. But so first of all, you store it in a way you can get to it. Secondly, there are lots of non-bank storage services out there where you can give them gold and silver and they will keep it in a vault for you. Texas runs a state-sponsored version of this, and there are a lot of other ones that are at least so far well-known and well-respected and trusted, and they'll store your physical gold and silver for you. Next, there are ETFs that'll do that for you, where you buy something like the Sprott Physical Gold Trust or something like that. You buy it like stock, but they'll store gold in an allocated way for you. You actually own the gold that they put aside for you. And then you go into equities that are of companies that own the physical assets. So everybody needs their own version of this kind of diversification. And for each person, it's different, but for each person, it's necessary, because we cannot trust the banking system anymore, and we haven't been able to for a long time. So it's just a matter of time before something blows up in the banking system, and some of us lose some of our deposits. We don't want to be one of those people. So we have to start prepping now for that kind of eventuality, because it's almost certainly coming, unless the governments of the world wise up in a hurry and then just do the currency reset without a gigantic crisis forcing them to.
It seems that often a gigantic crisis is not just avoided, but even, crafted to motivate the populace to want and to request and to feel the need for a revolutionary change, and then be told, okay, well, here's the solution. We could go down a litany of major crises we've had in our country where, surprisingly, a 2,000-page bill shows up within a week, or if not days, that Congress is voting on, so they can pass it, so they can find out what's in it. Any thoughts from you on the likely types of changes that are planned for us that might suddenly just be presented as the solution to a suddenly, quote unquote, unexpected crisis that might happen?
Well, you know that our would-be dictators have a saying, never let a good crisis go to waste. So they definitely have contingency plans drawn up for different kinds of financial crises. And presumably they've got a bunch of false flag plans drawn up for causing the financial crisis. But for stackers, for instance, it doesn't matter all that much because we're going to do what we're going to do, regardless of whether the government causes the crisis or whether it's some geopolitical thing like what's happening in the Middle East right now, or whether it's some other country screwing up in some monumental way that bleeds over into the rest of the financial system. Dozens of catalysts out there, but our response as individuals is pretty similar in every case, right? We want to be moving into real assets. We want to have as much gold and silver and as much exposure to other kinds of energy assets and other kinds of real assets. And with the expectation that those assets will hold their value better than financial assets. So, yeah, and you asked about what kind of plans they might implement in the next crisis, and there will be variations of capital controls, and that can take a lot of different forms, but one can be you can't move your money overseas. Another can be we're going to really limit how much cash you can take out of the bank in any given transaction, or how much you can have of certain kinds of assets in certain kinds of accounts. All of that stuff is completely possible, and none of it is predictable in the specifics. We don't know exactly what it'll be, but it'll probably be something like that. Because if you look at least American history, you see a lot of this stuff. They made gold ownership illegal in 1934, and they didn't make it legal again until 1971. So if we're capable of something like that, or if we have been in the past, then we're definitely capable of it in the future. And then there's all the AI surveillance that's becoming more and more possible, where they know what's in our accounts, they know what we're doing with our accounts, and if that's combined with central bank digital currency, which it probably will be at some point, then they're going to be able to control our accounts. So it won't even be mass capital controls necessarily. It can be very precise. You took part in a protest against the latest war, therefore we're shutting down your bank account, we're cleaning it out. And good luck paying your rent this month. That's the kind of stuff that can happen too. So you just want to be as far away from that kind of risk as possible. And without knowing what the specific risk is, it's just going to take the form of some kind of government control over our financial assets. And therefore, we want to be as far away from those kinds of financial assets as possible.
It's another saying, you mentioned one before, but another saying is that we're actually living behind enemy lines. That changes the way that you think about the environment. But as far as normalcy bias, or assuming that systems that others around you, your neighbors, your friends, your parents, or whoever, coworkers, are assuming will be there to support them, to support their well-being and their thriving. And for those who are preparedness-minded, you're assuming no, the vast majority of those systems are either not going to be there, not going to be accessible to me, or they're going to be overwhelmed and paralyzed through the unprecedented needs and burdening them, or they're going to flip and be actively hostile and rules changed or rules enacted or whatever that are going to be antagonistic to the well-being of my family and myself. Now, you mentioned just a few moments ago exposure to real assets. You've written on this topic before, and on the topic of, is this the time to bargain shop the best mining companies? Mining companies arguably are sitting on top of real assets, and yet they're under-owned and haven't been keeping up with the increases that have happened nominally in gold and silver recently. Any thoughts from you on how people can take advantage of that opportunity?
Well, yeah, gold and silver miners, their stocks have had great runs, and now they're correcting. And in a bull market, the way you deal with a correction is to use that as a buying opportunity. In other words, buy the dip. And we're in a bull market with precious metals, in which buying the dip is by and large going to be the right kind of strategy. So with the miners being down, I just posted a thing on Substack about, okay, here's how you use a low ball bid. I picked a miner that's not in our portfolio that I wish I had put in the portfolio because it's had a great run, but now it's corrected. So let's put a bid in at another, let's say 25% below the current price, and see if it drops hard one of these days as people, as the weak hands are shaken out in favor of the strong hands in a correction. See if we get our lowball price. And that's a way to get the stocks you want to end up owning eventually at bargain prices. And there's another way you can do that too, which is called put writing, where you use a put option to kind of simulate a lowball bid. And I'm going to do a Substack post on that in the coming week sometime. But yeah, when the overall trends are strongly positive, which they are for gold and silver. I mean, we're destroying the world's fiat currencies, which is massively big for gold. And for silver, we're running out of silver. And we're not producing enough anymore to satisfy industrial demand. So you've got monetary and industrial usage being very bullish for silver. So we want to continue to add to our positions, but maybe not at parabolic spike levels. So you wait for a correction, you put in a low ball bid for the things that you want to add to, the positions that you want to add to, and you use those corrections as an opportunity to get bigger in the positions that you want to hold for the next 10 or 15 years. So this is one of those corrections potentially, which means it's an opportunity for a lot of people. So we should be thinking about what the best mining stocks are now and which we do not have enough of. And we take those stocks and we put in lowball bids on them in the hope that we get them. So we round out our portfolio that way.
The technique that you mentioned of using basically selling of cash-covered puts as a way to acquire shares of something you wanted to buy anyway, and being able therefore to buy it at below market prices is something that I first encountered in one of the Rich Dad books by Robert Kiyosaki. We interviewed him in person on our channel back at the Red Pill Expo in Hartford, Connecticut. But he explained in his book, and just in real brief outline, because I know that people sometimes run screaming when you mention options, but this is something, if you have the cash in your account and you were considering and are interested in buying a stock anyway, then rather than putting in a lowball bid at a limit price where you would instantly buy that share should it trade below that price, and you'd get it at or below that price that you put the limit in, you can just make an offer of selling a put, which means you can put to me the shares at or below this price, and that way you get paid to do that. And even if that does exercise so that you do get put those shares, then you get to keep the the premium that you got paid for selling that put, and therefore you're actually buying it below the price that you had said you were willing to buy it at, because you're getting to keep that premium difference. So you can't end up owing more than that. Just the amount you have complete control over, limiting the amount that you're willing to stake towards that, just as you would if you were going to be buying it, but you're offering to let it be put to you at or below that price at that price, and you're being paid upfront to make that offer. So it is a very clever way. And if in fact the stock market takes off and you never get the shares, you still get to keep the payment that you were given for putting in that offer for selling that put. So it's an interesting strategy. And we'll put a link to your article that you wrote about "Is This the Great Taking?" in our description of this video. Now that article and a lot of your other writings come out on your Substack. Can you remind people how they can avail themselves of the Substack and what things are available for free there and what things cost a subscription?
Yeah, I'm at rubino.substack.com, and the newsletter is aimed at actionable advice for all the stuff we talked about. And we covered a lot of actionable advice in this talk. So that's an example of the stuff I'm writing about there. And most of what appears there is free. The only thing that's behind the paywall is specific investment advice with specific stocks and other instruments and strategies. So most of it you can get for free, and if you want to see the rest, you can pay $5 a month and get behind the paywall.
Well, John, we've always been grateful for your presence here for years on Liberty and Finance, and we're grateful today as well. And thank you for joining us. And guys, please look in the description of this video. You'll get a link to John's Substack as well as the articles that we discussed. John, thanks for joining us again on Liberty and Finance.
Thanks, Deligan. Talk to you soon.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for March 9th through March 16th, 2026, while supplies last. First this week, 1 ounce gold buffalo are just $199 over spot per ounce. Next, 1 ounce silver maples are $8.99 over spot. 40% U.S. junk silver halves are $3.50 below spot per ounce. And 90% U.S. silver junk dimes and quarters are $1.50 below spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.